markets aren't irrational some of the time. Markets are irrational all of the time.
Welcome to Wavelength, guys, where we dive into market and investing relating topics that may or may not be relevant to you, but are surely interesting to us. I'm Greg Ein here with Elliott from Qualitative Analytics and Dave Allman from Elliott Wave International. One thing before we start, investing is risky. We're not investment advisors. Make your own decisions. Okay, guys, let's get into it. Today's topic, it's home for us as we dive into the question, what are Elliott waves? Who better to answer this question than a couple of experts in this field? Dave and Elliott, let's dive in. What are Elliott waves? Where do they come from?
Well, Elliott waves stem ultimately from psychology. I mean, what moves the market? It's people being optimistic about something and making it go up, or pessimistic about it and selling it and making the price go down. So a herd of people ultimately shape what prices do, and these herds have a distinct way in which they move prices through time. And we call that the Elliott wave principle. This is basically what the pattern looks like. So you've got patterns nested within patterns, which is called a fractal. But the basic pattern is pretty simple. It's 5 waves up and 3 waves down. So 5 waves go in the direction of one larger trend. So there you go. 1, 2, 3, 4, 5. And then there's 3 waves that correct that trend. A, B, and C. And then these patterns repeat within each leg of the larger pattern. So this one is itself composed of 5 waves. And then again, the trend that goes against this trend is in 3 waves. Now, in the case of this larger 2 here, this ABC, the trend is down here. So now the moves going with that downtrend are in 5 waves. And the ones against that trend are in 3 waves. So it can take a while to get used to this if you're not, accustomed to the wave principle, because it's not a simple pattern in the way that, say, a Head and Shoulders is, where you just look for one shape and identify that. This is shapes that are, contained within other shapes, But once you get used to it, and, it's actually eventually does become second nature to be able to identify where the stock market is in this fractal progression. And I think I should show you a real world example, because Greg, you asked earlier, like, when does this come in useful? Well, I want to show you when I first discovered Elliott waves, because you'd think, okay, Elliott Prechter, Bob Prechter's son, I would have known everything about Elliott waves a long time ago, right? Didn't we talk about it at the dinner table? Actually not. I was more interested in computers growing up. I don't think I knew anything about Elliott waves. I had a good friend who was really into them, and he would always ask me at school about stocks and commodities, and I was just like, I don't know what you're talking about. But for me, it really came in 2008. I got my first job at Microsoft, and they had this 401k, and I didn't know what to do with it. So I went and got advice from somebody. This was right before that big crash, by the way. And they were like, yeah, put all your money in these unrated municipal bonds. That's a good idea. They're paying 13% yield right now, and tax-free. And I thought, man, that sounds like a great deal. Of course, a lot of those went to zero in the 2008 crash. And I called my dad up, and he's just like, no, don't get involved in any of that. Just put your money in T-bills, be safe. We're going to have a financial crisis here, which of course he was correct about. But of course that wasn't enough for me. And I thought, well, if we're going to have a crisis, why go into T-bills? Why not buy a bear market fund? So I bought the Prudent Bear Fund, which is an inverse fund, and it makes money when the market goes down. But I was noticing that this inverse fund was moving in waves. I was like, wait a moment. If I know I have 5 waves up in this inverse fund, then I'm going to have 3 waves down. What if I just sell it before the 3 waves down happens and then buy it back here? And that's what I started doing. And I started watching this fractal unfold. And let me show you roughly what that looked like. Here's the S&P with an Elliott wave fractal labeled on it. And during this decline, I basically started trading for the first time using Elliott wave principle. So I remember when we had this 5 waves down here into early 2008, I distinctly remember being in that fund, and I sold all my shares right at this low here. Okay. And then I said, okay, that's 5 down. We're going to have a rally, a large rally. And I went long. And I distinctly remember going long here And I was young and foolish. I was like 23, and I bought a double X long fund using 2x margin. So I was 4x exposed to the market. Don't ever, ever, ever do that. But I was an idiot. Luckily, I learned the dumb way, which is that I was never wrong basically during this entire period, because I was following FFS and they called every move of this, as I talked about in the last video. But yeah, I remember going along this, and I posted to this investment club talking about it, telling everyone I'd gone long. And you know, some people were like, well, that's crazy using that much leverage. And then another person told me, wait a moment, I thought you said we're in a big crash. Why are you going long? And that's when I had to explain, well, it's a fractal. Things don't always move in a straight line. Sometimes they go the other way. So yeah, I went long there, you know, and then went short and went long and went short again, and just kind of traded my way through this whole thing. In retrospect, maybe I should have just gone short and just used up a really large amount of leverage, like with leaps or something. But at the time, I was learning a lot about the Elliott wave principle. So again, you can see the fractal pattern here. We've got 5 waves down, and then, you know, within these we've got, you know, 5 waves and then 3 waves against the trend. That's the basic pattern. There's some other more complex patterns, like the sideways pattern here, A, B, C, D, E. This is called a triangle. But these are more advanced patterns that you don't necessarily need to know about for these videos. The simple 5 in the direction of the trend and 3 against is the basic idea of Elliott waves. And if you want to learn more, you know, elliottwave.com has a lot of resources. But as you can imagine, during this crash, you know, I had a lot of friends that lost a lot of money. And meanwhile, I was like thinking to myself, man, I can just quit my job now and just trade Elliott waves. So I was completely hooked after the 2009 crash, I would say. So I think it's really important to show how well this real world Elliott wave actually maps to this kind of idealized abstract wave, because this is what I knew at the time.
Yeah, I think Dave, there's 13 distinct patterns that Ralph Nelson Elliott described in his works, and is that correct?
I think I've read that.
And obviously, if you want to learn more about all those different patterns, you know, there's lots of resources at ewi.com, elliottwave.com. That's 2 T's, 2 L's, 2 T's. And, you know, this right here, this resource, Key to Market Behavior, goes into depth and detail about every single pattern and how you can recognize them. So check it out at elliottwave.com. All right, moving on. Anything to add?
Yeah, let me just say one caveat. Don't ever do the stupidity of what I did, ever. Because it doesn't take much of a move to wipe you out with that kind of, especially when you have margin. So I think every good trading book actually says you should never risk more than 1% of your capital on any trade, because that'll keep you in the game in the long run. So while that's a great example when the wave principle worked really well, there are other periods where it's much harder to tell what the waves are doing. And I think it's because waves are a reflection of emotions and mood. And during 2008, when there was a lot of emotion, ironically, the market was very, very clear in terms of Elliott waves. And in my personal opinion, when there's not a lot of emotion in the market, it's not as clear. So you do have to be careful. But the nice thing is that there are rules with the wave principle, like wave 2 can't break wave 1. So it gives you places to put your stops. So if you're incorrect in your forecast, you know exactly how much you're risking. So I think that's the really powerful thing. I didn't mean to talk so much about leverage. Even I just thought it was hilarious that I did that and survived. But, you know, in practice, to me, the biggest virtue is actually the other side of it. It's the safety. It's the fact that you can define risk and management, which I learned the hard way later on as I continued trading and you know, had some rougher times in other markets.
Dave, any thoughts?
So I like diagonals. I like ending diagonals. And the reason I like ending diagonals is because the whole idea behind an ending diagonal or a wedge, however you want to refer to it, is that once the pattern is complete, the ensuing move happens very, very quick and is often very, very sharp. And the reason that's key to me as a mediocre trader, okay, is because it doesn't give me enough time to screw things up. Ending diagonals are great because, you know, the longer you have to think about possibilities as to what's going on, the longer you have, at least for me, speaking only for myself, the longer you have to go, well, wait, I wonder if it's this, or I wonder if something else is going on. Because I guarantee you that while we would love to think that everything is 1, 2, 3, 4, 5, and it's just gorgeous and there's no other way to interpret it, followed by an ABC, and it's gorgeous and there's no other way to interpret it, that is not the reality of the situation. So, and I've said before when I've lectured, the wave principle is not for people who demand closure, because there will always be an alternate wave count. If you don't have an alternate count working, you're not paying enough attention to the market.
Like what would you say to somebody who is just new starting out?
Okay, so how long does it take you to learn the wave principle? It depends on how many charts you're willing to label. If you're only going to try and label one chart a day, it's going to take you longer than the guy who's going to try and just tackle labeling as many charts a day as they possibly can. If you're only going to label a daily close chart, it's going to take you a lot longer to get this practice time in to label to learn how to apply the wave principle than if you're looking at a 10-minute intraday chart. And you just try and just look at the market, try to label the patterns in accordance with the rules of the book. And at some point, I think it was a line from AJ, at some point the scales will drop from your eyes and you'll be able to see what's going on. And I got to tell you, I remember, the first time that I was like, I actually found 5 waves on the chart, and like Prechter counted it, and it was such a huge deal. And I think we lose sight of that when we sell analysis sometimes, because the wave principle itself, the idea that markets are patterned, the idea that it's not fundamentals, that it's not the news, that it's not the Fed, it's not all this other crap that's out there. Okay, it's psychology. Markets aren't irrational some of the time. Markets are irrational all of the time. Okay, and crowd psychology is patterned all of the time. Does that mean you know exactly where the markets are all of the time? Yes, but I keep it to myself.
Well, here, a great example of when you talk about markets being irrational all of the time. I like that a lot, actually, because there's people who look at, like, in particular, value and sentiment, who have done well over many market periods, but who suddenly got crushed during the last rally from 2009 to present, because a lot of those metrics of value and a lot of the metrics of sentiment have just gone to insane levels that we've never seen before, like way beyond what happened in 1929 and even the 2000 tech bubble and the real estate bubble. And so relying purely on those kinds of indicators, I think, can be problematic. And the reason is because the market doesn't really have rationality. If the market was rational, then you wouldn't get bubbles and crashes, right? So that's the nice thing about the wave principle, though, is it works even in that environment. It's the wave principle says, well, okay, there's no limit to where sentiment can go, but the wave principle isn't directly tied to sentiment; it's to price action, and price action itself is unlimited, right? So that's why it's really useful. There are specific areas where it's kind of the only game in town too, like crypto. That's a great example. Like, nobody knows how to value crypto or where crypto's going to go. There's not a lot of fundamentals you can even look at anyway to try to be quote unquote rational with it. But with the wave principle, you can still analyze and trade cryptocurrencies that way. Yeah.
Elliott, on that, what advice or encouragement would you have to somebody who is just started out learning the wave principle? What kind of advice would you give them?
Someone who's just learning, I would say, you got to read EWP, the Elliott Wave Principle, Key to Market Behavior. Read that one. That's a really good book. I also like another book that we sell, which is Visual Guide to Elliott Wave Trading, because that shows a lot of real markets, individual stocks, examples of options trades and equities trades, futures trades, using the Elliott Wave Principle. It's going to get you an idea of what to look for in terms of setups and, how to quickly identify an Elliott Wave in real time. That's a really good book. We got a lot of resources at elliottwave.com. And if you really want to go the distance, like if you want to be an expert on Elliott Waves, then you need to become a CEWA.
So a CWA stands for Certified Elliott Wave Analyst. Correct. You become a certified in Elliott Wave analysis.
It sounds correct.
Okay.
Yes.
Yeah, you can even put it after your name, like a little comma, and you put CWA there.
I would,
everyone to address you as such.
To the question, what would I have somebody just starting out do? I would think that even Elliott Wave Principle, which is where I started out, but I think there's a better, easier choice these days, and I know that it's fresh because Bob just worked on it over the course of the last month and a half, and that's learn the essentials of the wave principle in 30 minutes. It's a lot simpler. It takes out you don't get the philosophical stuff. You don't get a lot of the detail. You don't get the long list of guidelines and tendencies that various waves have. And do you need those eventually? Yeah, you do. But if you want to just get an idea for how, is the wave principle right for me to take the time to learn, I would start there. Just to, 1, 2, 3, 4, 5 ABC.
I'd say that resource that you just said is that one of my favorite resources because it really lands the foundation of what the Elliott Wave Principle is. And if you want to learn more, you can with Key to Market Behavior.
Yeah, Elliott Wave Principle, Key to Market Behavior, and people can get it. They don't have to lay out a dime. They can get it for free. It's it's 90+% is as accurate as what the real book is. It's on our website. So, and then there's lots of things they can spend money on, in various areas. But I think that, we think that the wave principle is something people should become familiar with. It's not a panacea, but on a relative basis compared to what is shoved down your throats on a regular daily basis from the Federal Reserve Board, from the traditional Wall Street, conventional wisdom, etc., the wave principle is worth having in your wheelhouse.
All right, guys. Well, I guess we'll wrap up. Thank you so much for coming in and having this conversation. I hope that we were able to answer a little bit about what are Elliott waves and how they would help you and why you might want to put that in your toolbox if you are an investor and trader. We have a lot of resources here at Elliott Wave that you can check out if you want to dive deeper into how it could help you learn more about it and the patterns. So go to elliottwave.com. Again, that's 2 L's, 2 T's, and check out our resources there. Dave, Elliott, thank you very much for this. So I appreciate you guys coming in and look forward to the next time.
Thanks, Greg. Right. Elliott.
Welcome to Wavelength. I'm here with Greg Ein.
There's
here with myself.
Right there.
Yeah.
Okay.
I'm here with myself today.
Opportunities happen every day in the financial markets across the planet, from minute-to-minute moves to long-term trends. If you don't know what to look for, you can easily miss when these opportunities are knocking at the door. Elliott Wave International can give you the tools to make sure you don't miss another opportunity ever again. For over 40 years, our publications have been keeping traders and investors ahead of the curve in the financial markets, not to mention the numerous educational resources we offer to teach you how to use the Elliott Wave Principle, as well as strategies to help make you a better trader. For as little as $2 a month, you can get access to special reports, books, live events, and up-to-date commentary for stocks, bonds, commodities, the US dollar, and much more. And if you want deeper insight into the markets, we have you covered as well. Our monthly publications give you an in-depth look at stocks in the US, European, and Asia-Pacific markets, as well as coverage on cryptos, forex, energy markets, and interest rates. Don't let another opportunity pass you by. Go to elliottwave.com today.